Okay. I'm a bit later than usual in recording this report, and it's probably for the best. Josh Kepke here with McDonald Realty. Last week, the Bank of Canada raised interest rates by a monstrous 100 basis points, the single largest increase since 1998. This will have significant ramifications for the housing market, not just psychologically, but financially. One of the pillars supporting the housing market has been the variable rate mortgages. They've been dirt cheap, averaging more than 150 basis points cheaper than the fixed rate mortgages this year. For this reason, we've seen an increasing number of new purchasers opting to go with a variable rate mortgage. So far this year, over 50% of new mortgage originations have been variable, and that's a historically high figure. If you were going with a variable rate mortgage in recent months, you were not subject to the higher mortgage stress test. Remember, the mortgage stress test qualifies the borrower based on the minimum qualifying rate of 5.25% or their contract rate plus 2%, whichever is higher. In other words, with variable rate mortgages hovering around 3%, you'd only be stress tested at 5.25%. Compare that to borrowers opting for fixed rate mortgages, and you'd be getting stress tested at nearly 7%, 5% mortgage rate plus 2%. Now you can see why a borrower would go with a variable rate mortgage. Now the Bank of Canada has raised interest rates by 100 basis points, and this will instantly bring the typical variable mortgage to about 4.2%, which means you'd be getting stress tested at 6.2%. In other words, the average home buyer just lost about 10% of their borrowing capacity in one fell swoop. It's not hard to figure out what's going to happen next. The pool of prospective, or rather qualified home buyers is shrinking. June home sales in Greater Vancouver, they fell 35% year over year and 21% below their 10-year average. Again, this shouldn't come as a surprise once you run the math. Let's compare the cost of carrying a home today versus in January, just 6 months ago. We're assuming 20% down, 5-year fixed rate mortgage with a 30-year amortization. In January, that home price would have been $1.19 million with a 2.5% mortgage rate, and you'd be looking at $3,755 a month. In June, that home price would have been $1,235,900 with a 5% rate, and now you're looking at $5,277. So you get the same home with the privilege of paying an extra $1,522 a month. With the Bank of Canada aggressively moving interest rates higher, you can now apply that similar math for variable rate mortgages. While nobody knows where interest rates are going to end up, if you believe the market, overnight swaps are suggesting the Bank of Canada will hike the benchmark rate to 3.75% by the end of this year. Now, while I remain skeptical that the bank's actually going to get there, it would be worth noting that that would equate to 350 basis points increase in interest rates this year, which is approximately the amount that's required to trigger most fixed rate variable mortgages. In case you need a primer on this, 80% of variable mortgages outstanding are fixed payment variable. The monthly mortgage payment stays the same until it becomes negative amortizing, not enough principal being paid down. This number tends to be roughly around 350 basis points higher than the original contract rate. So suffice to say that this would be a hot mess, and I'm guessing that the banking regulator would be itching to step in, likely creating a new policy to extend amortizations. So remember, back in 2007, we had 40-year amortizations. This product is already available in the multifamily commercial via CMHC. So don't think it can't happen again on the residential side. So we've got weak demand, but there's not a flood of sellers. It's no secret that prices have been moving lower since the peak in February. However, despite the popular narrative, it's not due to a flood of panicked sellers throwing inventory on the market. In fact, new listings in Greater Vancouver were down on a year-over-year basis across all segments. New listings are running 3% below their 10-year average. Furthermore, total inventory for sale is actually down from last year, dropping 11% from last June. I know it's hard to believe that there's actually fewer homes for sale today than there were a year ago in the blistering hot sellers market. Current inventory for sale across all property types remains low on a historical basis. However, buyer demand is just so weak that months of inventory for sale is still building. It currently sits at 4.2 months of inventory, which is typically considered a balanced market. Basically, what's happening here is that prospective buyers they're in shock over the rapidly rising interest rates. While some no longer qualify under the higher interest rates, the majority of them appear just to be on hold, waiting for a better entry point. These buyers are going to need more inventory to come on the market in order to pressure the sellers into reducing prices a whole lot further. There's a good chance that happens, but as we can see, it takes time for inventory to accumulate. Vancouver is rarely an oversupplied market. So let's move on. Let's look at the pre-sale assignments. They are back on the rise. Rising interest rates and declining resale prices do not bode well for the pre-sale market. The pre-sale market is heavily dependent on investors. Many new project launches today are asking prices that are well above similar new construction resale prices. So what's the incentive to tie up money in a pre-sale if the price outlook does not appear favorable? We are seeing an uptick in new pre-sale assignment listings across Greater Vancouver and across the Fraser Valley. It appears that the pre-sale buyers are trying to sell their existing obligations. There could be some interesting opportunities here, as some of these pre-sale buyers will have issues obtaining financing in the rapidly rising interest rate environment. In our experience, very few pre-sale purchasers lock in financing several years out. So long as the buyers purchase at the right time and have enough equity, they should be fine to close. They just might have to go through the private lending channel. So it'll be the buyers that purchase near the top that could have issues with the appraisal and or the higher interest rates impacting their ability to qualify. This is still very early days, and this is certainly not an issue at the moment. But if the housing market correction drags on into the next year, we expect to see some opportunities. So hey, I'm Josh Kepke with McDonald Realty and Vancouver Real Estate Today.ca. And if you are thinking about when is the best time to sell, or whether or not it's a good time to buy, or when does it make sense to invest into real estate, just give me a call or a text at 604-313-9805. or an email to sold@joshkepke.ca. Hey, and if you want to have the inside edge on the real estate market, or you want to see some tours of some amazing properties, just subscribe.